No, first, thanks to Dick and Rob for the invitation to be here today. It's great to be back at Stern in this room. And before beginning the panel, I did just want to, again, thank NYU Stern and the Volatility and Risk Institute for hosting FIO's catastrophic cyber conference last November, which, like today's event, was very, very successful at bringing together academia, the public sector, and industry. And I think, as you heard today, as we look at those challenges, including climate, cyber risk, bringing together those different stakeholders is crucial as we look at these multifaceted issues. I'm also aware that the National Science Foundation supports NYU Stern and its work. So I did want to spend just a moment or two talking about a new initiative that our team has recently launched this week. Our office is now partnering with the NSF and private stakeholders as part of a new industry University Cooperative Research Center on Terrorism and Catastrophic Cyber Risk. This project was the first time that we've ever partnered with NSF, and very excited to be here today to sort of, show the commitment that we have to working with all different parts of the markets. The center we set up this week is going to support research and solutions to government, academia, and stakeholders, for additional data and modeling and underwriting tools with regard to ensuring terrorism and catastrophic cyber risk. I know that's not the subject of today's, but there are a lot of the similarities when you sort of look at the systematic effects of those different risk perils. So I think it's just great to be back here today on another important issue. And with that, we'd just like to quickly start by introducing the panelists. It's great to be here today in person with Superintendent Kane from the New Mexico office, Commissioner Kreidler from Washington, who I believe you're all seeing on the screen, and then also Deputy Commissioner Peterson from California. And before turning it over to our panelists, I'll just start with a little bit of context from the federal side. As many of you have heard today, this is a priority issue for us at Treasury and the Federal Insurance Office, and we've been focused on this issue since the President issued the executive order on climate-related financial risk in 2021. As many of you know, I think, very happy to announce last month that the Federal Insurance Office is doing a first of its kind collaboration with the NEIC and state insurance regulators on a nationwide data collection process. And, very excited to be here today with Superintendent Kane and also, Commissioner Kreidler and Deputy Commissioner Peterson to sort of talk about, some of the work that we've made going forward collaboratively to look at these issues. The NEIC is going to now be able to collect and share data with over 80% of the U.S. property insurance casualty market. And I'm sure that many of you in this room are looking at it from the academic and both the industry perspective, appreciate the value of that information. And I think from our perspective at Treasury, we view the joint data collection as a win for FIO, the NEIC, the states, the insurers, and the American public. And I think we're very much looking forward to collaborating with the NEIC as that work goes forward. And I'm very happy to be here today to moderate the panel. And maybe with that, if you don't mind, I would turn it over to you to maybe just give maybe a brief introduction and maybe kind of what are the issues you're most looking at in New Mexico.
Well, I've been here all morning, so I was the only insurance regulator this morning, so I'm glad that you've all come to join me. I was totally outnumbered by the industry. But I've been superintendent in New Mexico since last June. Before that, I'm a lawyer. I was general counsel of 2 insurance companies, and then I was in private practice. So that's my background. So I'm sort of new to this regulatory game, and I'm also new to New Mexico. I was pretty excited when the governor called me and asked me to come apply, and it's been an exciting 9 months. We can go to the things I'm worried about, but before we go, just to sort of commiserate with you, we did have a hack, and we were shut down totally for a month and then had to rebuild. So I wouldn't wish it on my worst enemy. People don't quite understand how much it is to rebuild and get started. So my sympathies for those that have it. The insurance is interesting, but going through the process was a challenge. What am I worried about? What don't I sleep at night? We are a state that has wildfire risk. That's really been, we had a large fire before I came that actually was started by the federal government doing cleanup. And we're still working with FEMA to get, reimbursement for some of the people. And it's sort of interesting. We are a state that Many people are underinsured. We also are a state where in that northwest part, it had been generational homes that people just lived in, so they're having a hard time proving title. So we're now turning to some of the title insurers to see if they can help us. We do have a fair plan. Our fair plan is much more modest than some other states. We have a $350,000 cap that was just raised last year, not this session, 2 sessions ago, to 350,000 and $1 million for commercial. We are excited to be joining the other members of the Western Zone we're having a Western Zone meeting that starts on Tuesday. We're all going to collaborate and talk about some of the wildfire risks because we are all struggling with it. So I'll start with wildfire risks.
Thanks, Amanda. And then maybe turning to our colleagues on the screen, maybe start with the Washington perspective.
Well, thank you for inviting me here. This is indeed a pleasure to be back again to speak to this conference. This is something that has been near and dear to my heart since I first became insurance commissioner some 24 years ago. So I've been working on this issue since then as one of my major priorities with the insurance regulators, and certainly to help us even in the state of Washington. And we certainly face some challenges. Well, our number one challenge, of course, is like many states in the West, it's flooding, but quickly catching up with them is wildfires. And I think that is the one where we are perhaps needing the most preparation and particularly when it comes to getting insurers to be much more engaged and recognizing the differences and the risks that are out there going forward. So this is kind of the really the rubber's hitting the road. Before, when we were talking about it some 20 years ago, it was a little bit more philosophical. And I think what we've seen now in the last few years is that it is extremely urgent that we address this issue of climate change, and as regulators that we're on top of the question of are insurance companies aware of kind of risks that they have with certain types of investments that they may be making, and certainly taking that into account where they wind up offering insurance to make sure that they're not going to be losing. We don't like to have insurance companies go bankrupt, particularly when we're the commissioner. We're going to work hard to make sure that they have all of the information they need to be in the market, reasonably priced, but at the same time being a prudent insurer for the marketplace. Thank you.
No, thanks for that perspective. And obviously, I know this is an issue you've been working on for a long period of time, and I think really helping shape a lot of the state work. So thanks for your efforts there. Maybe Mike, we just heard a California perspective from our last discussion from Nancy. So maybe you can just give an update on how things are going in California and where you and the team are focused when you're looking at some of the potential challenges in the market.
Thanks very much, Stephen, and thanks again to the hosts for having this panel. I mean, similar to my colleagues, Superintendent Kane and Commissioner Kreidler in the Western U.S., we in California really have focused a significant amount of our initial attention on how to reduce the risk of wildfire, but it's part of a broader challenge of climate risks. I mean, within our state and within many states, you have a combination of wildfires, flooding, and extreme heat events that can have compounding short and long-term economic impacts. And so, while most of the press is about wildfire, I do want to take a moment to just highlight how significant atmospheric rivers are to our jurisdictions. In some parts of my state here in California, over 95% of the flood insured losses come from atmospheric river events, which aren't hurricanes, and they're not necessarily a type of storm that we hear a lot about, but it's a phenomenal amount of water for communities that may or may not be prepared for it. And the reason, as a state regulator, I'm very focused on that is that we're concerned about the protection gap, the gap between the costs of events that are insured and the overall cost of events totally, because insurance has always been a strong mechanism of resilience, ability to get, some recovery as fast as possible. And for these atmospheric rivers, we estimate about 2% of our households in California have flood insurance, which means 98% of households are affected by those events in full. And I think that throughout the West, that's likely the case. And so, as we think about these climate risks, it is something that I get a lot of value out of collaborating with our other state regulators in Washington, Oregon, New Mexico, Arizona, because these events cross state boundaries, the economic impacts can cross state boundaries, and so that coordinated effort is really valuable.
No, thanks, Mike. And maybe just staying with you. I mean, a lot of the panels today have discussed, a lot of the academic research of looking at these topics, and not only from the insurance perspective, but also interconnections with, real estate markets and banking markets. And, what are your views on sort of the collaboration that's now going on between both of our respective teams? I mean, I know that was a process that's taken a little bit of a time, but when you sort of look at the PCMI data call that the states are doing and sharing with FIA, I mean, what are you hoping to learn from that exercise, and how do you think that can kind of help the conversations that we're having here today?
I think, Stephen, it's a very timely question. As a kind of former academic in some ways myself, I think that we really are focused on the fact that having good data is critical to making good decisions for consumers. And so there are different ways in which we view the risk to insurance markets, the risk to properties, the risk to communities. And I think that we have a timely way to collect data across our jurisdictions and then to learn from that. So in many cases, California already collects data on some parts of what we see as the risks of disasters. But the challenge becomes is that, as you cross over borders, there's a lot you can learn, and there's a lot of collective strength in the data that you can collect that kind of combines California, Nevada, Arizona, Oregon, and you can see what's going on in the Sierra Nevadas as a region and not as two separate jurisdictions. And I think that really underscores kind of a broader point that both Superintendent Kane and Commissioner Kreidler alluded to, which is that with some of these climate risks, we really are connected. Knowing what's going on broadly in the markets and having a national picture that supports solutions like resilience benefits us as state regulators and allows us to really plan. And I guess I'd say the last thing is just that this data will feed into the NAIC's climate resilience strategy, which was just adopted about a month ago in March. And so not only do we have an opportunity as state regulators to collect the data, but it has kind of an immediate application, and that we now have a resilience strategy that looks at pre-disaster mitigation for different types of climate risks and impacts, and allows us to look at the collection of our jurisdictions in a broader way. And I think that universities and any other research entities, and even like your own team, like this is an opportunity to take a bunch of information that has been used to address specific topics in the past and make it as valuable as possible for understanding insurance markets. And as far as I can tell, that's something that's not really ever been done as a big collective effort in such a coordinated way. And I think we're going to be able to see where do we have successes and where do we have challenges, and what then data do we want to collect for the long term? Because in many of these cases, we're going to be looking at wildfire risk in California for a very long time, and we have been for a very long time. But now we have sort of a new mechanism in order to tackle that problem. And so I look forward to the success of this data call, the compilation and analysis of the information, and then working together to try to interpret what what are some of the policy solutions that are already occurring and what can be added on.
No, thanks, Mike. And maybe keeping it with Commissioner Kreidler. I mean, one of the issues I'm sure that you're seeing around the country is the challenges regarding affordability and availability of coverage. And in your role, as an insurance regulator, how are you trying to balance the competing objectives of maintaining the solvency of your market, while at the same time being cognizant of the some of the strains we're seeing on pricing, coverage, availability, and affordability? I mean, how are you kind of viewing it from the Washington perspective?
Well, I think number one is that we're really encouraging insurance companies to take a look at their book of business and how they've priced it, and certainly from this consumer standpoint, making sure that they are apprising their policyholders to keep their a value that they're insuring up to being replacement value. So it doesn't come as a major shock if there's a total loss. And I think that's a big one for a lot of people. And I think it's a lot of it's education, and that's something that we're working hard to do through our office with outreach, where we've had staff in Eastern Washington for on and off for months now, really getting ready for what we anticipate will be another fire season where we could be at risk. And again, even though flood is the number one issue statewide, fire is quickly catching up, and the devastation of fires. We had something like 400 homes lost last year. And I think it's incredibly important that the information that is necessary to make sure that people have their policies up that are realistic for replacement value. And also I'm concerned that insurance companies do not become overly concentrated in areas that are going to be prone. And that might mean that there'll be some non-renewals on the part of some insurance companies, but it is on a selective basis. Strongly advising and encouraging, and have not yet seen anything to the contrary. They'll stay in the market, but just not with as much of a footprint as they had previously. And I think that helps us to make sure that we have a strong, vibrant health insurance market out there, along with making sure that they're taking the steps to harden their homes against wildfire. So that's something that we're working very closely with statewide with the fire marshals and with others to make sure that they're taking that fully into account.
Thanks, Mike. And I think Superintendent Kane, one of the areas that Commissioner Crowder just touched on was the importance of consumer education. You heard the figures on, the 2% flood uptake in California. I mean, from your perspective as a regulator, how are you sort of viewing issues of consumer education, and maybe contrasting that with kind of your prior roles in the sector?
First thing, we are the number one state for drought. So flood is not our issue right now. It's wildfires. Our concern, or we're getting numerous phone calls from legislators, the governor's office, and individuals that accessibility and renewal of policies is the bigger problem. And then there are areas that insurers are not writing in. So what we've done is now, instead of asking you if you're leaving the state, if you're going to leave a product line, we want to know about it. We've been working closely with our fire marshals for years, but the fire marshals have various zones, but that does not seem to be what the insurers are focused on. They've sort of changed their models, and they're looking at something different. We've had some pretty exciting activity in the broader sense of mitigation. That Santa Fe County has been doing a large with my people and the fire marshals and whatever. We've been doing a lot of outreach and mitigation, and Santa Fe has a new they call it a WUI code, and they've been giving certifications to various homes if they've done remediation. And we have a tool at the office where if you come in and you've been non-renewed or you're having problems, we can take you to your house and show you what your house looks like and see where, do you have a lot of brush? As a matter of fact, they took me to my house and I'm in big trouble because I have one of those coyote fences, which is sort of like a matchbox, which is, beloved in Santa Fe. So that's going to be an interesting thing. And our governor is extremely interested in this because she wants development, and she's having developers call her and tell her there's certain areas they're afraid of developing in because of the insurance piece. And we're struggling with, is our FAIR plan enough? How do we handle the high value homes? How do we continue development? And she's sort of tasked me. I don't report to her, she points out clearly, and I agree. But we are trying to come up with whatever innovative ideas, we can find everywhere. And I also found it was interesting. I was talking to the Rhode Island superintendent. There are only 3 superintendents. She's another one, and how she's dealing with the flood, some of her flood areas, because the concepts, although different climate risks, we're all trying to solve them in different ways. So we're trying to find great ideas wherever we can.
And just where are you sort of seeing your focus being in New Mexico the next, 2 or 3 years in this area? Like what do
2
you-
or 3, I mean, I think it's decades, but we're trying to find new ideas. We're talking about, the 5-foot rule where so many of the houses do survive if there's a wildfire. It's really education and mitigation. So we can, as I said, I think earlier, so we can really talk with the industry and sort of say, will you give the homeowner credit for that? Can we work on the rates with that? Yeah, whether it's a rebate or a rate reduction, I don't really care what we call it. I just want some relief. And really the bigger, as big an issue for us, I guess we've got 2 more issues. One is having the insurance, renew and also have availability. And then we have the underinsured. I mean, there's, I think there were like, I don't know the percentage. It was very, very high. Many of the homes in that area where we had the big wildfire were not insured. And, again, FEMA is coming in because the federal government started the fire, so it's a little different. But it's really been tragic up there. And we're also having problems with some of the commercial reinsurance. Gallup, I got a phone call from the senator who couldn't get his commercial properties insured. So he's ready to have a hearing. So this is going to be one, I'm not going to, it's going to be a major, I don't want to say hot, it's going to be a major topic in the state.
No, thanks for that, Superintendent Kane. Maybe just, Mike Peterson in California, obviously you're coming off hosting the big Global Sustainable Insurance Summit a few weeks ago. Obviously, we're hearing a lot about California in the news with regarding to some of the regulatory changes you're working on in your team and some of the legislative potential changes. I mean, what were some of the major takeaways from that conference, and sort of where are you trying to take things forward, including with some of the work you're doing at the FAIR Plan?
Thanks, Stephen. I think that just to start with the major takeaway is just that insurance, when it comes to climate risks and climate change, has often been sort of a side tangent subgroup of a subgroup meeting. And with this summit, I think we really, determined that it has to be sort of center in how at least we're thinking about climate resilience, because the risks have grown and the risks are causing impacts that are really hard to keep up with. And so at our Global Sustainable Insurance Summit, we had more than 150 attendees from 6 different continents. And just looking at the diversity of interest, and let me just give you a couple stats that, if you count the organizations, there are 27 state and national governments represented, 30 nonprofits and foundations that include those who focus on insurance, like United Policyholders in California, those that focus on home hardening, like Smart Home America, those that fund resilience generally. And then we had over 11 academic institutions that participated, some rural, some urban, some small, some large. In California, we have lots of universities in our Cal State and University of California system. And so just the level of interest in insurance was really striking. And I kind of say there are 3 major takeaways that at least I see at this point. And I think this will grow over time because it was the first one of these summits that we've hosted, and it's the first that we've had a significant number of insurance regulators attend, including those from places like Ghana and Australia, as well as from 16 of the U.S. jurisdictions. But I'd say the 3 major takeaways are first that the challenges facing insurance markets often start upstream of the actual purchase of insurance. And so that means that pre-disaster mitigation that occurs as a result of federal, state, and local investments in either the hardening of infrastructure or in the restoration of natural infrastructure are essential to reducing future losses. And that's really challenging because that means that you need coordination amongst those levels of government, also between the private sector and the public sector. And so creating those connection points to make sure that you have coordinated efforts I think will be one of the lasting impacts of the summit, because those folks who were there were able to look at each of their individual climate resilience strategies, how they fit together, and what they could do in partnership. And then secondly, when we're addressing, let's just take wildfire, since all three of us regulators are from the West and we all deal with wildfire, that access to actionable risk information continues to be a challenge. So what are the factors that that can reduce the risk of wildfire to communities and the risk of future losses? We get some information that's experimental through institutions like the Insurance Institute for Business and Home Safety about how to harden a home. But there's so many things that communities do, that neighborhoods do, that city and county governments do, that are really hard to categorize, and they're critical. So how we take that information and bring it together to make it actionable was a second takeaway. And then the third, I'll say without going on too long here, is just that the communication of both risk and risk reduction to local and governments and communities really is like the end of the implementation that can be really challenging. And I think that this underscores the importance of our work at the NAIC in our coordinated national approach, because as insurers change the way they do business, whether that's creating incentives that incentivize people to bring down risk, or reshuffling where they're writing that leaves some areas more exposed to being part of the FAIR plan. These really are things where there are some core fundamentals that require us to coordinate as state regulators and to coordinate with our individual local governments. And so I think that we came away with examples from the Netherlands and from Brazil that I think are really helpful. And hopefully those initial partnerships that came out of the summit will then carry forward. And I'll be able to report back in a year that we have some metrics of progress in reducing that risk and enabling a more affordable and available insurance market in the future.
Thanks, Mike. And maybe Commissioner Kreidler, obviously over your tenure heading up the department in Washington, the state has taken a very leadership role at the NAIC and among the states on these issues over the last 15, 20 years. I mean, looking forward from your perspective, having that long view approach, and then where do you sort of see the need for maybe some near-term prioritization, and what do you see as sort of the next steps that each of us should be thinking about?
Well, I certainly think education is going to be a big part of it, and communicating. We're getting out there and working with some of the communities like we have in Eastern Washington with the Methal Valley. They came and did a presentation, in fact, to the NAIC when we got together in Phoenix here about a month ago, and described just exactly how they were doing it and what they were doing in order to harden their community against wildfire. In fact, it's in a valley right now, but they're in the process of taking it county-wide in a very conservative rural area of Eastern Washington. So it's starting to have some very positive effects from that standpoint. But along with education, it's going to be critical of something we were talking about earlier, which is data. One of the challenges has been that there hasn't been a lot of sharing in the insurance industry, particularly those larger insurers that do their own work in-house. That information is not shared broadly, and as a consequence, it's kind of denied to the rest of us. Strongly believe that there's a way of being able to aggregate that data in such a way as to protect their proprietary interests, but at the same time help us to have the kind of data that is really necessary. Because as we look toward the fire season approaching us, we are in drought, which is kind of an interesting situation when you look to California, which got rained on. They got a lot of the rain that normally comes to Washington went into California this year. That wasn't true for the last couple of years, but it certainly was this year. So as a consequence, we have drought here. And I'm frankly worried about Eastern Washington in particular, but even here in Western Washington, we've got to be paying a great deal more attention to the fact that we're we potentially could have a very challenging fire season in 2024.
Well, thanks, Commissioner Crider. And maybe just for some context on the data collection piece, because I do think when you're looking at some of the analytics that this group is doing, that really is a big, a big change in sort of the underwriting report. I mean, historically, publicly available reporting information is at the state level, right? And this is the first time you're having a national data collection of over 80% of the market at the zip code level. So that's a much more granular level of information. You're getting information on premiums, claims, losses, looking at deductibles. So I do think when you're looking at some of these questions that each of us are wrestling with, this will be a really, I think, a positive step forward.
Absolutely.
Maybe just to Superintendent Kane, I mean, one area that I think is obviously a priority for your state, as well as for us at the federal government, is mitigation and resilience. I mean, there's been a lot of at the federal level, we've had a lot of really significant pieces of legislation passed that are looking at mitigation resilience. You talked about some of the work you're doing in New Mexico. I mean, when you look at your sort of work, both at the local level in New Mexico, but then more broadly at the state level, is I think Mike Peterson was mentioning, where are you sort of looking for next steps in the mitigation resilience piece?
Well, I think, as we said, we were looking at, some of the things with Santa Fe, but we're looking at a state level, talking to the governor about, building codes and some of the things that you can do on a broader level that just makes sense. The 5-foot rule, clearing the underbrush, getting the communities to understand that they have to work together. I mean, my people have been going out around the state with the fire marshals, giving programs. They've done it in the past and they're doing it now. I think, again, because we are in such a drought mode, everybody's listening and everybody's concerned about this next season and hoping we're spared, but who knows? But I do think, I think the legislature and the governor are extremely supportive. So we may be able to get more of a statewide approach, hopefully on some of those building codes, but the counties are very active.
No, I think the building code issue is important. I mean, when you look at sort of some of the markets that are on the southern Gulf Coast as well, I mean, there are, you really can see when you look at the analytics that the building codes do make a big difference, particularly for some of the hurricanes.
And I think the governor's very concerned about the people that, the grandfathered groups, then some of the people that can't afford the remediation, and how we can create some sort of a way to help them so the whole community benefits and they do as well. So, again, we are a poor state that have to help everyone.
And being that as we're at NYU, maybe for either of the mics on the video, I mean, I know one of the priority issues at the NEIC in the States is kind of building that pipeline of future talent with regard to joining the insurance sector. I know it's something, the federal government as well, we also are sometimes struggling with. And in front of some of the students here at NYU, what's your advice to a student that's aspiring to join this type of career path? I mean, anything from your perspective?
I can jump in first. Commissioner Crowley, did you want to go first?
No, Mike, go ahead, please.
I think that there's two things I'd say. One is that, from my perspective at least, the insurance sector has never been more important to the resilience of all of our communities. I think if you look, across the board, whether it's flood, fire, or other issue, the communities that have had strong insurance availability have recovered more quickly and more fully. And I think that's a really important piece of society to work well. And so making sure that this sector works well, I think is a critical part to our future. And it's also an area where, I think that science and risk science has, the growth in that field will have an impact. And so as sort of, kind of the future workforce in a lot of areas, those tools and skills are going to be really important to the insurance sector, and hopefully will help us sort of align all these different challenges that we have, because we really are seeing risks that are different than they were 50 years ago. But we need insurance to work as well as it has, and even better, and be more inclusive in the future to the resilience of communities. And so I think it's a really I don't want to use the word exciting because it's also, it's a very sort of
Challenging.
serious professional thing, but I think I think it's a very rewarding area to go into, and I think it's going to have a lot of these like risk science skills and tools that become more and more important over time. Because I think as both superintendent, I'll just wrap up and say that as both Superintendent Kane and Commissioner Kreidler mentioned, we're as insurance regulators, we're an incredible, public resource of just explaining insurance and helping people understand a really complicated scenario. And so our teams here have had to adapt as well in terms of understanding catastrophe models more, understanding risk mitigation more than maybe we did even a decade ago. And so I just think it's an area of increasing interest and increasing importance to the public largely.
I couldn't agree more. I think that the insurance companies it's going to be a ripe opportunity for any number of insurance, if not all of them, from the standpoint of doing a lot of the planning and analytical work that they need to do in order to anticipate where they can do business and do so without being at significant risk, and then playing an active role and making sure that communities, if you want us to be offering product in your community, you've got to take steps here to make sure that we're going to have adequate safeguards against wildfire, and the building codes and land use practices are going to be such that it makes it a good place for us to effectively be offering policies, much less any investments that we wind up making in the future. I think that's just such a ripe field right now. They're all of the insurance companies are kind of scrambling on this issue because quite frankly, American insurers are probably a little bit slower to the game than the Europeans, partly because of the mix of that you have in Europe of insurance and banking regulator being effectively tied together much more solidly than you do in the US, where banking is federal and state, and the state does the insurance portion. So it was always kind of one of those kind of laissez-faire type of approaches that the insurance companies had, where they would, if we don't like, if we feel that there's too much risk, we'll just stop writing in certain areas. Well, that doesn't work. Yeah, we're a democracy, and the vote of the people and the will of the people are going to be exercised, and that could come to the detriment of the insurance company if they have not been playing an active role. And I think they really understand that much better now than they did even 20 years ago. But Hurricane Andrew, even in the late 90s, really started to change the dimension of how insurance companies looked at the risks that they were vulnerable to with climate change and the steps that they could take to make it work better. And I think we're going to wind up with huge opportunities in those companies from the standpoint of they need new talent to address their issues, whether it's analytical or whether it's engineering, whatever it might be. It's going to be a place ripe for their opportunities in the future.
Oh, I've been in the industry so long. I started out at NYU Law School, and New York Life was my practice interview, and I ended up general counsel, and then I ran their asset management business. And then I went on, which was fascinating because it's such a different business than property and casualty, because you really are more into the investment side as opposed to other things. Of course, you have to stay up on some of the medical issues as well. I think what was exciting about going to Zurich, and I think you realize how global these issues are. And Zurich, as you know, has companies here, Zurich North America, and they manage but do not own farmers. So you see the you see the global problems. You see how different countries and states approach it based on their own culture, but we're all trying to solve the same problem. And I think right now, climate is one. I think the European approach to carbon footprint is way ahead of us. I also think the modeling that at least I saw in Europe maybe 15 years ago was way ahead of what I think we were doing here. But as we heard from our friend from the Geneva Association, modeling is going to change dramatically because the past used to be predictive at some level of the future, but now we're really going to have to take it. As she said, we're going to have to rewire our minds, and I think that's interesting. I remember the CEO of Zurich, who was an American, Jim Shiro. He said, "Alice, nothing moves without insurance," and it's a challenging career. And Mike McGrath, your predecessor, said to me, who's a friend, he said, Alice, now that you're a regulator, you're helping people every day in their everyday lives. So I've never had a boring moment. And if you had told me that insurance would be challenging and exciting for these many years, I probably would have said no. It was my practice interview and my practice job, and I haven't left the industry since.
And maybe before we take a few questions, I would give, Deputy Commissioner Peterson, maybe just a chance for you to, anything you want to flag about some of the regulatory or legislative initiatives you're doing. I mean, we did hear a lot about that in Nancy's presentation a few minutes ago, but anything you want to flag about the premium discounts, how you're looking at reinsurance, forward-looking cat modeling? I know there's a lot that you're doing with some of the California issues.
Yeah, absolutely. Thanks, Stephen. I think I'd make 2 points. One is that on the risk reduction in California, in October of 2022, we finalized regulations that required insurers to reflect home hardening actions and community hardening designations in their rate filings. And so that's currently being implemented. And as a department, we're helping consumers navigate how to work with their insurance company to make sure that if they've done the 5 feet of they keep changing the name, but the first 5 feet, zone 0, whatever the sort of immaculately cleared areas around the home, make sure that those things are reflected in the premium that they're paying. And so I think this is an incredible need over the next couple of years, is to be able to effectively communicate and implement those incentives so that the consumers adopt them broadly, because the more individual homeowners take those actions, it benefits their entire community as well. And so I think that that's really the kind of engine of mitigation that we're trying to accelerate here in California. And so that's what's ongoing. Stephen also kind of mentioned the other regulatory processes that we have that are ongoing. Starting last September, Commissioner Ricardo Lara, who's our commissioner here in California, had launched his sustainable insurance strategy, and that's going to include multiple regulatory changes that are going to happen in 2024. As many of you know from previous presentations, California does have some unique aspects to the rules for writing insurance in California. Catastrophe models have not been allowed to be used to estimate catastrophe adjustments in rate filings here in California. We're in the process of, we do have a publicly available regulatory draft out of how we're looking at changing that. We just had a workshop last week where we had over 700 virtual attendees. Not all of them made comments, but we had many written and verbal comments on that draft. And so we're going to be working on that this year. That's coupled with a number of other regulatory reforms that as altogether will be the largest reforms that California's seen in 30 years. And so I think that we're really trying to be thoughtful and methodical but increase the ability for these risk assessment tools to be used at the same time that our insurers are committing to write more in some of the higher risk areas of the state. And so our hope is that this pairing of additional risk assessment tools and more insurance access in some of the areas where we've seen insurance companies retreat from will be the most sustainable way forward for our state. And I think that, at the core of this really is that we want insurance to be available. We know that mitigation is a critical component of that. And so aligning all the different ways mitigation has an impact, whether that's just the roof, or it's within the first 5 feet, or it's the defensible space, or it's the community mitigation designation, or it's all the work that happens in the national and state forested lands. Our hope is that that information can be reflected in a way that incentivizes more risk reduction in the future and more insurance access as soon as possible. So that's where our regulatory reforms are going. And I think, Stephen, I just end with, like we really have seen over the past 5 years, I'd say between 2018 and now, a growth in our FAIR plan from about 150 or 60,000 policyholders to a little bit over 350,000 policyholders today. So it's not astronomical, but it's substantial, and that's the problem we're trying to address, is how to reverse that trend in our FAIR plan and then reduce it down back to where we think is a more baseline level for the ultimate goal of the FAIR plan, which is to be the last resort and not common. And that's where we're trying to take the market, at least through our role as the regulator.
No, thanks, Mike. And maybe any questions from the audience or anyone?
Could I take the host prerogative and ask a couple? For all of you, Superintendent Kane alluded to the fact that this is really a global problem. And I know that last June, Stephen, you hosted and participated in, and some of you also may have done that, an EU-US summit on insurance issues. So one of the questions I have is, we think about stress testing financial institutions. Insurance companies have the own risk and solvency assessment, or BORSA, and there is no explicit climate piece of that, just as there isn't yet really for other parts of stress testing for other institutions. But I know NAIC is considering enhancing that, and obviously that's a big challenge. It's a challenge that we could potentially meet with some of the tools that we're developing and others are developing. And I want to know how you think about that. I have a second question, if I could, and that is, Nancy and you all have talked about hardening, and Nancy asked the question, where's the financing going to come from? And she has some really innovative and creative solutions to that. So wondering if you have additional thoughts or thoughts on her proposal.
Well, as you said, I do think this is a global problem, and I guess I was a little disappointed at the earlier part of the panel, because I was hoping there'd be more of a openness, at least from the industry, working with us and understanding, once mitigation is put in place or things happen, how can we work together to make it more accessible or whatever. I think that may have just been the individuals. I'm hoping there's going to be more openness when we go into the industry. As I said, because we are a poor state, the governor's been looking at ways to maybe support this, putting a fund together and whatever. One of the things we were talking about, I don't know if it's going to happen, but we're talking about is we have a patient compensation fund where the initial, the doctor has to buy the initial 250,000, then we have a fund. We're thinking maybe we use the FAIR plan to be an initial piece, and then maybe build something on top of that for the higher value properties. But again, if you're going to participate in that kind of a thing, there would be a strong mitigation piece. And that 5-foot story, as it seems so simple, but at least from what we're seeing from all the studies, it's incredibly powerful. And that's one of the things we're just preaching again and again. And then community, activities, because you can just see it. We can go in with our tool and see what the communities, what the houses, you've got the
Drones.
yeah, right. That fly over, that can see the roofs, but you can also see what's going on in the mitigation. So it's really going to be, with everything that's going on, it's going to be easy to tell how the properties have done it and if they've done it. So that's why it's going to be factual. So we're hoping the industry will respond to that.
Great.
And if I could just add on the funding portion there, like I agree with Superintendent Kane that it's a real challenge. One thing that I think I get some hope for is that as you're looking at this global problem, and also it as a national problem, if you look across the US, there are examples of where some states have used mitigation funding programs to help low and moderate income homeowners achieve at least some of the mitigations. And so I would say there's a very successful program in Alabama and their Safe Home program in trying to basically simplify down the mitigation actions to take enumerating those and then providing some state funding that goes into grants that then helps individual consumers take some of those actions. Now, it's not earth-shattering, but if you line it up with building codes for new buildings, these types of grants, some insurance incentives, then hopefully you start to chip away at the total number of homes that need to be that need to be updated and mitigated. And then, there is without putting any pressure on Stephen here, there is a federal piece in terms of there's a significant, federal interest in reducing risk. And so I do think that there are, really important grant programs that have helped us, at least in California, get money to where there's less capacity to do that mitigation. And so I think, at least the way we've tried to structure it is that if our mitigation incentives in the insurance sector are lined up with grant opportunities, that does help at least some people, more people than could have afforded it just on their own, afford to take those actions. But it does still leave a really challenging scenario to get to full mitigation.
Thank you.
One of the challenges has been that we want people to harden their homes. We want them to take steps here to help prevent wildfire. But at the same time, we wind up in a situation where they say, well, how much is that going to reduce my insurance premium? And I kind of go, we're trying to make sure that you have insurance, that it's affordable, and it's quality insurance. And now you want a cheaper price on that. You've got to convince the insurance companies that you're a good risk out there. And a big part of that is starting to do the education here so that people realize that not all homes are on the same level when it comes to risk, and that you're going to have to take that risk into account. And that's part of underwriting. And if you want to have good quality insurance, you've got to be prepared to make some changes in how we do business. And that's a very, very hard one to sell to the general public. They have a perception that somehow they can save money by doing these things. And I'm saying, no, we're trying to make sure you keep your insurance, not the other way around.
Thank you. Great points. And by the way, keeping your insurance will help sustain property values as well.
It's true.
Great. Questions from the audience before we adjourn and go upstairs?
Thanks. I have a rather specific question for Deputy Commissioner Peterson. There's a bill in the California legislature, I think it's 1060, Senate Bill 1060, that would require insurers that use risk modeling to consider mitigation efforts. The insurers, I think, say that you already require them to do this. I'm wondering, does the department consider that bill duplicative? Are there other mitigation efforts that bill would require the insurers to take into consideration that the department doesn't already require them to do?
Yeah, I'll try to answer that the best I can. I mean, it's I'm not going to sort of speak to any particular piece of legislation being good or bad, but I think that there's a couple of distinctions there that I just want to highlight. One is that within the department's current approach, our regulations focus on the pricing of insurance, and what makes that price not inadequate, not excessive, and not unfairly discriminatory. I think, generally speaking, what legislation like the bill that you brought up are trying to do is to look at the underwriting of insurance. So where insurance companies write a policy versus not. And that tends to fall outside of our general scope of focus. And so that's sort of the distinction there. So within the pricing, we're completely, I guess we were prioritizing how to incorporate wildfire safety into the pricing of insurance. And so we've done that through the home hardening rules. We've included community designations like Firewise communities, or in California we have fire. I've now forgotten it, but we have another fire distinction that the State Board of Forestry certifies, and so those are incorporated into that pricing of insurance. With this bill, I think it would deal with underwriting and with the models that are used with underwriting, which is just not something we generally have scope over. And so So I don't know exactly, where that will go. I do think that oftentimes, the last thing I'll say is oftentimes the same catastrophe models that are used in underwriting decisions are also used as that catastrophe factor in the pricing. And so as we take a look at our regulations that are underway this year, which the drafts are out, we are focused again on mitigation being in those catastrophe models. And at least in our current draft, it expressly states that it has to be. But again, that's the pricing side. So hopefully that's a helpful sort of distinction of, potential legislation versus, what's within the department's current strategy.
One point I think we haven't made so far, and one is that I've been around long enough to see it happen, and it's called a hard market. And reinsurance prices have gone up rather considerably, and they're having a tremendous impact on the affordability of insurance. And I would suggest that at least in most states, if they're seeing a uptick in their FAIR plans participation, no small part of that is because of the pricing and availability of insurance because of a hard market. Insurance companies have insurance companies that they rely on, and when those markets become a lot harder in the sense that they're more pricey and less available, it has a very direct impact on the consumer as a result of that. And I would say that a big part of what we're watching in the state of Washington right now is really driven by this hard market and in both in pricing and availability, which is not an issue for us normally, but we're starting to see some changes. Even our FAIR plan, which is extremely modest, it has wound up seeing a 2- or 3-fold increase, but it's largely driven by hard market factors, not wildfires, that are causing the changes right now. So, but it is a factor out there that you have to take into a consideration. It's like climate change. It's not just what you see here today. It's what takes place over time, and that clearly right now, a hard market is exacerbating some of the challenges with the insurance world.
I have to echo what you're saying, Commissioner Kreidler. Right now, our FAIR plan has doubled, and we're doing our first assessment, I think, in 10 years.
Yeah.
In some sense. No. In some sense, the real problem is that our housing and our businesses and so forth are located in high-risk areas. And so ultimately, we're going to try to rebuild, migrate, or something like that. And there's an enormous cost. It's pretty hard to see how insurance can actually help with that, except in the situation that we talked about today, where if the property is destroyed by either fire or flood or sea level rise or something like that, what are the obstacles to allowing the homeowner to rebuild in a safer place? I mean, I don't think that, is this part of California legislation that makes that difficult, or is there issues in in morality that prohibit this, or can the homeowner just take the proceeds and take them someplace else?
I guess for New Mexico, it's not like we can move them back from the ocean. They're sort of all over the place. So I don't think we have that luxury. I would also say that we've pushed for replacement value, and the cost of that with inflation and replacing is also another pressure, along with the reinsurers and the hard market that's causing the
So
rise.
you can take the replacement value and do whatever you want with it?
Yes.
Okay.
But I think, again, I don't think we can move people. the way New Mexico is, I'm not sure we can say there's a safe place to go. I think the real issue for us is really mitigation.
Well, as soon as you know what the insurance prices would be in different locations and they're set actuarially, then the homeowner can really decide where they want to go and what risks they want to pay for and what risks they want to avoid. I mean, that seems ultimately like
You know,
the right.
They don't like they don't like where we have trees. So I'm just saying, and then the rest is the desert. So I don't think yes, you're right. They will make the choice, but I think it's, you know, for our state, I think if we can get the mitigation right, then maybe we can, you know, do it. And I think the other issue is maybe not going so high up the hills because the fires go up.
Just from the federal perspective on the actuarial pricing, I mean, this is a real live issue you're seeing with risk rating 2.0 with the National Flood Insurance Program. They are going through a process of trying to do actuarially sound premiums, and there are a lot of competing interests. There's a lot of, it's a very difficult process. That, you know, and something I think, you know, FEMA's working toward the program, but then you have to balance, you know, what are the caps on premium increases year over year? How are you going to think about people leaving their communities? How do you going to think about it's very difficult.
It's just,
Well, that's kind of what I was wondering. How do you think about all that rest of that stuff? I mean, and one thing is, of course, maybe knowing what the actuarial values are for your house might be separate from what the current insurance rates are.
Yeah.
Mike Peterson.
Yeah, good.
Oh, I was gonna just say, you know, just to compliment Superintendent Kane here. In California, at least, there's no rule that says, I mean, if you have a total loss from a wildfire, that insurance reimbursement that you get, you can take and move elsewhere and buy a house elsewhere or build a house elsewhere. So it really comes down to, I think, the awareness of risk and the options that that the public have in the aftermath of these disasters. And so we don't, so I don't see there being like an insurance barrier to that in California, at least. I also think that there is, you know, I mean, I would just offer that for those who do rebuild, you know, building code upgrade insurance is common as something that insurance companies offer. And I know it sounds like very nerdy, but basically, if your home burns down and you have a building code upgrade endorsement, you can build back to the newer codes rather than having to fill that with your own funding. And that can make homes more mitigated looking into the future. And so it's still a disaster and a tragedy that the home burned, but there are multiple ways in which insurance can help either mitigate the future home or allow for a survivor to make a different decision about where to live. The challenge is that most insurance policies in California, at least, don't include flood. So that's not going to be an additional driver there, except for the 2% of people who may have flood insurance.
You, of course, don't recover your the land value. If you just take the replacement cost, then
you do. The rules changed in 2019 legislation to so that it is an equivalent choice whether you choose to stay or you choose to move.
I have a real quick question for you, actually. So, and this, all right. It sort of ties this together, I think. Thank you. This is your question too. Yeah. So, well, both of you. So I thought if I understood the panel earlier, Prop 103 provides a significant tax advantage, and it can be overwhelming to rebuild where the house was. So when you were asking about getting up and moving, yeah, you can do that, but you're going to lose that tax advantage, which can be tremendous, right? Did I understand your comment correctly about that?
Now, well, we should have Commissioner Peterson. You
Sure.
can now move your bases since 2019. It's much easier.
Since 2019.
But before, it was more difficult. And
Gotcha.
then Rob's point about the land is very true.
Right. No, of course, yeah.
Yeah, just one point about Rob's question and then my own question. Nothing in insurance regulation prevents you from taking the money and moving somewhere else, but your lender doesn't let you. So your mortgage, if you have a mortgage on your home and you have a loss event and you get an insurance payment, usually that claim is paid into an escrow account at the bank, and the bank has to sign the check so that the household can access those funds. And they have an interest in you not running away, because then they're going to bear the loss in the mortgage. So there is mortgage lock-in that keeps people in their house. So I'm working on a paper on this, heads up, for anyone that's interested, but I think there's more, it's not a regulatory constraint, that keeps people locked in. And then a related question, thinking about like insurance regulation and banking regulation, how, both groups, banks and insurance companies are often exposed to the same collateral and the same property. And so is there a way in which you can think about using the learnings of insurance modeling to help the banking sector think about modeling this risk, or vice versa? Has that kind of collaboration between regulatory bodies happened?
I don't think so. I think that's what the speaker at lunch was basically saying. Let's break down all these barriers and silos and get everybody together that's interested in the problem.
And like, what would it take
I
to do
think
that?
maybe New York has an advantage there, since banking and insurance are under the same agency.
Shan.
I'd like to ask a question also about regulatory innovation. So we know, as academics, we're thinking there are ways to make insurance more affordable, which is to share the risk widely through some financial market innovations like cat bonds and sell it everywhere and have all. In my research with Rob and the co-authors here on Insurance, we find that large insurance companies that are more diversified are exposed to less climate risk and potentially can be able to offer insurance at a lower premium. So in insurance regulation, there are, when you calculate the capitalization ratio and so on, there are some benefits in if insurers are more diversified in terms of operationally. I wonder whether there are considerations that regulators thinking about innovating to encourage more risk sharing with the wider capital markets to make it easier, and also to kind of encourage insurance companies to be more diversified or capitalized.
I think they feel they make that strategy themselves. But I think the one thing you're talking about is spreading the risk. The Nevada commissioner and I and some other Western groups, because we're trying to get the high value homes, taken care of, because they don't come within our fair plan and whatever. We're thinking about, or talking to people about, maybe is there a regional model that we could sort of spread it more geographically? But that's the only, spreading of risk that I've been involved in to date.
Yeah, I would just, if you look back at the NFIP program, right? They got new authority to do a reinsurance program, right? So now they have, a pretty significant reinsurance program. They also have, they are now issuing some cat bonds now as well, right? You're seeing this down in the cyber market as well. So the capital markets is taking on some of this risk, and they're also familiar with it in like the hurricanes. But on the global scale for some of these wildfire, I don't think, correct me if I'm wrong, I have not seen any ILS based on wildfire.
I think we're sort of struggling with that on our own.
Yeah.
Well, please join me in thanking Stephen, Superintendent Kane.